Okay, dear everyone, while we are still waiting for our registered audience to join our webinar, I would like to take the opportunity to give you a short introduction to MySteel. Some of you might be familiar with MySteel, but for those who don't, MySteel was incorporated in 2000 and it has now grown into a globally leading data service provider for commodities and related industries. As an independent third-party organization, we offer multi-dimensional data with prices at its core, spanning various segments for the industry chain like supply, demand, inventory, cost, and so on. It provides decision-making support to both industrial and financial clients and has gained widespread recognition and application both in the spot and the derivatives markets. MySteel is listed on the Shenzhen Stock Exchange. MySteel New Energy is relatively young, but we have quickly established its presence in the industry via our sophisticated methodology and extensive network in the industry. The team now has more than 20 analysts and data collectors monitoring the market dynamics on a daily basis, and the team aims to provide the most accurate market intelligence to help with decision making. Now let's move on to today's webinar. Is winter over? China battery materials market for the Q3 review and Q4 and 2026 outlook. Today's session will cover key minerals, including lithium, nickel, and cobalt. For lithium, we will have a brief review of China's lithium market in the third quarter this year and interpret key factors driving the price rebound, followed by MySteel's outlook into the lithium market in the fourth quarter and 2026. For nickel, the focus will be the nickel ore supply based on Indonesia's RKAB quotas, as well as the nickel sulfate market dynamics amidst robust EV market demand. Lastly, we will go through the cobalt market following Congo's export quota system and discuss how far the cobalt prices will go. Now let's begin with the lithium market review of Q3 and the factors driving the price rebound. I will be the speaker of this part, and I am the English editor at MySteel Global with a focus on the lithium-ion battery market to provide in-depth coverage of China's lithium market with a focus on price change, inventory, capacity utilization, consumption patterns, and China's industrial policies. To begin with, let's quickly go through the lithium price moves in the third quarter of 2025. While the lithium prices were persistently soft in the first half, the third quarter began with a rally, which was basically driven by the rumors that the lithium mines in Jiangxi province will likely be suspended due to compliance issue, and the momentum was further enhanced by CATL-affiliated mines actually stopped production due to license expiry. Coupled with the government's rhetoric of anti-involution, the lithium carbonate futures price quickly rebounded to nearly 90,000 yuan per ton around the middle of August. But the lithium prices soon pulled back for the lack of strong support on the demand end, and the supply void was quickly filled up by other players raising the production. And a few production lines also came back online after maintenance or license renewal. After staying range-bound throughout September, the lithium price performance improved recently post-China's National Day holiday, partly because the demand end showed strong resilience, as is indicated by some key indicators. The inventory is always an important cog measuring the short-term balance between supply and demand. Currently, my steel checks the lithium carbonate inventory held by lithium converters, traders, and downstream players on a weekly and monthly basis. The converters inventory by region, the marketable lithium carbonate inventory, as well as futures warrants inventory. Let's first look at the futures warrants inventory. Of course, the hedging and derivative strategies are complicated and diversified. There are usually two scenarios when the warrants inventory shows significant changes. First, when the spot and futures price is in the contango structure, the traders inclined to purchase on the spot market and sell on the futures market, and the warrants inventory will decline, of course. The warrants inventory will increase during this period and vice versa. Second, the warrants inventory will fall when the demand is especially strong and the consumers purchase from the traders, and traders holding warrants will cancel the warrants and make the delivery. Looking at the graph in the lower right corner, the warrants inventory dropped in the second quarter. If you still recall, during this period, the lithium futures price constantly created new lows with the fundamentals remaining soft, and the outlook was gloomy as well. But the warrants inventory started to accumulate when the futures market rallied in the third quarter. Recently, the spot futures spread was again in the contango structure, but the warrants declined, which was basically caused by the traders canceling the warrants for delivery based on our investigations with the market players. And on the other hand, the overall lithium carbonate inventory held by lithium converters, traders, and downstream consumers also showed constant declines, which suggested the liveliness on the demand end. Here, let's look at the lithium ore stocks, which are primarily spodumene stocks. The traders' lithium ore stocks have been falling as is shown on the graphs, which prompted them to hold the prices especially firm. On the contrary, the converters that rely on outsourced feedstock have been building up stocks, suggesting that they are quite confident about the demand end and are preparing for the production wash. And it is more straightforward if we look at the monthly, look at MySteel's monthly tracking of lithium carbonate consumption. We see that in the first half of 2025, the monthly lithium carbonate consumption was relatively flat post the Chinese New Year holiday at the beginning of the year, and a strong demand rebound was observed in the third quarter, especially September. And the monthly consumption is expected to create a new all-time high in October, with a monthly demand of around 120,000 tons. While the demand end has been quite robust, the supply side has been active as well. In the first 9 months of 2025, China's lithium carbonate production totaled around 164,800 tons, rising 34.8% compared with the same period last year. From the perspective of raw materials, the lithium carbonate production based on spodumene rose quickly thanks to the commissioning of new capacity and shifting of some hydroxide production lines to produce lithium carbonate. For lepidolite, the production slightly increased when the CATL converters resumed the production at the beginning of the year, and the production lines with a capacity of 10,000 to 20,000 tons per year slowed their production due to poor profits. Then the lepidolite-based lithium carbonate production quickly declined after CATL mines suspended the production. And it is still uncertain when these mines will come back online, with some suggesting this year and some believing the mines will come back early next year, but it all remains to be observed. And China's lithium carbonate production is estimated to reach 84,900 tons in October, rising further by another 1.7% compared with September. And apart from domestic production, the lithium carbonate imports contribute around 20% of domestic supply. The cumulative import volume from January to September reached around 173,000 tons this year, which was a year-on-year increase of merely 5.2%, much lower than the growth of domestic production, which went up nearly 35% year-on-year in the first 9 months. In terms of import sources, Chile remains the largest supplier, with imports of around 113,000 tons over January and September, accounting for 65.5% of the total, though this number represented a decrease of 13 percentage points compared with last year. Imports from Argentina were approximately 49,000 tons during the same period, accounting for 28.6% of China's total imports, with a substantial year-on-year increase of 60%. An important observation is that though China's lithium carbonate imports from Chile went down around 13% over January and September 2025, a certain amount of lithium entered the Chinese market in the form of lithium sulfate, which bears lower cost throughout the entire production process. Now let's move on to the second part, which is the outlook into the fourth quarter and a glimpse of the next year. Looking ahead over the fourth quarter of 2025, the traditional seasonal high is expected to persist, but the demand end is due with risks. According to the existing policy, all new energy vehicles purchased between January 1st, 2024 and December 31st, 2025 are completely free of the vehicle purchase tax, with a maximum exemption of 30,000 yuan per passenger vehicle. However, starting from 2026, the policy will change. For vehicles purchased between January 1st, 2026 and December 31st, 2027, the purchase tax will only be cut by half, capped at a reduction of 15,000 yuan per vehicle. This shift in policy is expected to significantly influence consumer purchasing behavior. We anticipate a clear year-end rush in 2025, as buyers are likely to bring forward their purchase plans to the fourth quarter, aiming to avoid higher tax costs starting 2026 onward. And historical patterns tell us that ahead of policy phase-outs, demand tends to be pulled forward. Therefore, we project that the demand for raw materials will remain strong through October and November, with signs of a slowdown possibly emerging in December. And I would also like to bring your attention to commercial vehicles. The electric heavy-duty truck sector has emerged as a key growth driver, with sales surging by an impressive 180% in the first three quarters of 2025. And these vehicles demonstrate significant advantages in cost control, environmental protection, and technology innovation. They have become crucial tools for reducing costs and improving efficiency, especially in specific scenarios like medium and short-term fixed routes. Now let's examine their economic viability and application scenarios. Fuel costs account for 32% of the operating expenses for long-distance trucking fleets, while electric vehicles can effectively reduce these costs. For example, on a 320-kilometer route in East China, an express company named Shentong has achieved a cost reduction of 0.45 yuan per kilometer by switching from diesel trucks to electric heavy-duty trucks. However, it's important to note that electric heavy-duty trucks are currently best suited for medium and short-distance fixed routes, and their widespread adoption still depends on the development of charging and battery swap infrastructure. Currently, comprehensive promotion of electric heavy-duty trucks continues to require policy support. Subsidies from both national and local governments remain crucial to bridging the economic gap between traditional and diesel trucks. And now let's see the batteries. The battery sector is highly correlative to the vehicle market. Benefiting from good overseas energy storage orders and the growth of power batteries, battery factories have taken the initiative to reduce inventory for nearly 2 years. Judging by number of days, the battery inventory has returned to a reasonable level, and this year, the growth in the energy storage sector has been especially active. Usually, there are three drivers behind the growth in energy storage demand. First, raw material prices. These prices directly determine the cost of energy storage systems, making their fluctuations a crucial factor for the energy storage market. Second, battery lifespan. The longer the service life of storage batteries, the lower the cost per unit of energy storage. This makes longevity vital for economic viability. Third, the peak-to-valley spread in electricity prices. A wider price difference means higher economic returns for energy storage systems, making electricity price volatility essential for profitability. Currently, the energy storage market remains primarily policy-driven, with installed capacity showing constant growth. Subsidy policies across regions typically depend on local renewable energy integration capacity, often following a first to install, first to profit approach. We anticipate the energy storage market will maintain its momentum in 2025, potentially even exceeding expectations. So here are also a few events that's worth attention on the market. On the supply side, several projects that suspended the production for overhaul or due to compliance issue have duly resumed normal operation. And in the follow-up, it is still necessary to pay attention to the license renewal pace of lithium mines in Jiangxi and the resumption time point of CATL mines. And on the policy end, it is recently announced that certain lithium-ion battery-related technologies will be restricted from export. These new restrictions primarily target dual-use technologies, meaning they have both civilian and military applications in sectors where China holds competitive advantages. Compared to previous export restrictions that covered natural graphite, high purity artificial graphite, and certain lithium iron phosphate production technologies, the new measures significantly expand the scope. They now include controls on high energy density batteries and their production equipment, ternary precursor materials, high compact density lithium iron phosphate, artificial graphite, anode and cathode technologies, as well as related manufacturing equipment. For lithium ion batteries, especially, the main restriction focuses on high energy density batteries. Since these currently represent a very small proportion of China's exports, the immediate impact on domestic industry is expected to be limited. And while solid-state batteries typically fall into the category of high energy density of above 300 watts per kilogram, their mass production in China isn't anticipated until after 2027, meaning short-term effects will be minimal. Looking at the medium to long term, this policy may accelerate a strategic shift for Chinese companies, moving from material exporters to technology leaders. This transition would strengthen supply chain autonomy and enhance pricing power. Meanwhile, overseas companies might face slower progress in localizing their production capabilities. And always, a tariff is always a key focus that worth constant attention. And here also comes the focus on China's 15th five-year plan, with detailed action plans yet to be rolled out in the following weeks or months. But based on the now available proposals of the Central Committee of the Communist Party of China for formulating the 15th five-year plan for national economic and social development, the policy priorities are moving beyond broad layouts to precise and targeted actions. This heightened focus on a modern industrial system, high-level opening up, and public welfare signals China's commitment for next 5 years. That is, we will double down on industrial competitiveness, global market expansion, and improving livelihoods for common prosperity. And coupled with the anti-involution introduced earlier, we can reasonably guess that the follow-up focuses will be how to strike a dynamic balance between supply and demand, which differentiates itself from the strategy of supply-side reform taken in previous years. And MySteel, of course, will keep tracking the policy changes and inform our readers in a timely manner. Okay, and based on MySteel's analysis, we expect China's lithium market will see a supply shortage of over 50,000 tons LCE through 2025, driven collectively by unexpected supply disruptions and stronger than expected demand. And the lithium prices are projected to show a monthly average of around 75,000 yuan per ton in October and November, and then pull back a little bit in December when the production rush will likely slow down with the cut in EV subsidies. And looking ahead over 2026, we believe the lithium market will likely achieve a relatively tight supply-demand balance, primarily thanks to resilience on the demand end. MySteel will be giving more detailed a prospect soon, and you may stay tuned for our next webinar, which is scheduled in early 2026. And as for the question we brought up in the very beginning, is winter over for lithium? We think yes, unless the market is subverted by any major technology breakthroughs. Okay, so this is the end of the lithium sector. The next is nickel. The speaker for the nickel part is Cora. She is an English editor at MyStew, specializing in researching, writing, and editing articles on the nickel market. Her expertise covers market overviews, price trends analysis, and supply-demand dynamics. Now I will give the floor to Cora.
Okay. Okay, hi everyone, I'm Coral from MyStew. And now I'll introduce the fundamentals of the nickel market in the third quarter of this year, especially the dynamics of nickel ore, nickel pig iron, refined nickel, and nickel sulfate. In the third quarter, the global nickel industry struggled amid fluctuating macro sentiment, supply concerns, and oversupply, while different segments of the industry chain experienced different dynamics. The core theme was in the face of oversupply. The third quarter began with a wave of optimism fueled by China's anti-involution policies, which aimed at curbing excessive industrial competition that leads to diminishing returns. And the market was also fueled by the anticipation of US Federal Reserve interest rate cuts. Both pushed the nickel prices higher in July and early August. However, due to the lag in the policy implementation, market demand failed to demonstrate the corresponding strength, and the nickel price dropped. And on December 1st, a large-scale demonstration and protests took place in Jakarta, Indonesia. This raised market concerns about nickel raw materials, and nickel prices rose rapidly. However, as the incident ultimately failed to affect nickel production in this region, and nickel prices gradually dropped. And in the middle of the month, Indonesia's Ministry of Energy and Mineral Resources imposed a 60-day suspension on 119 mining companies due to environmental issues. And the market as a whole was cautious. Coupled with a relatively small actual impact, nickel prices moved range bound. And as the end of the month approaches the China's National Day holiday, the market was wait and see. So in the third quarter, the long-discussed structural surplus began to become more visible in rising inventories for refined nickel. Although the battery industry has demonstrated remarkable strength through nickel sulfate, the traditional stainless steel sector still faces great pressure. And okay, let's look at the nickel ore. In July and August, the price of nickel ore in the Philippines remained stable. The mainstream transaction price of 1.3% grade nickel ore was around CIF price of 42 US dollars per wet ton, and that of 1.4% grade ore was around the CIF price of 50 US dollars per wet ton. Supported by the price increase of nickel pig iron downstream, miners maintained a firm stance, but this was slightly influenced in September. Typhoon affected the shipment from the Philippines, while the Indonesia's Ministry of Energy and Mineral Resources strengthened environmental supervision over the mining areas. And these events, combined with strong downstream demand, pushed the nickel ore prices and premiums slightly higher by the end of the quarter. And in the third quarter, the mainstream price for lateritic nickel ore gradually followed a slight downward trend, though the decline was limited by multiple factors. For example, in Indonesia, although premiums dropped somewhat, frequent incidents curbed the decline in nickel ore prices. And in the Philippines, with the end of the rainy season, prices dropped to some extent against the drop of weak demand. On a monthly basis, nickel ore prices declined in July, although mining areas like Surigao and Mindanao in Philippines were still affected by rainfall. Loading and shipping efficiency was stable, and downstream Chinese NPI smelters, while seeing slightly cost pressures, were still operating at a loss. Shifting to the imports and exports of nickel ore. China's nickel ore imports rose to around 6.3 million metric tons in August, up about 26.8% month-on-month and 28.7% year-on-year. And according to statistics from China's customs, the total nickel ore import volume for the third quarter of this year is estimated at 17 million metric tons. This increase was driven by a noticeable recovery in shipments from the Philippines during the third quarter. And looking ahead to the fourth quarter, shipments from the Philippines are expected to decline as the Philippines enters its rainy season. And considering that Chinese NPI smelters have a demand for nickel ore prices are projected to remain firm in the fourth quarter. And about nickel pig iron, at the beginning of the third quarter, the price of nickel pig iron first declined and then rose, with the overall price remaining at a low level. And in early July, the transaction price of nickel pig iron in China hit the lowest point of this year, with the price dropping to 950 yuan, including delivery and the tax. Then, driven by the introduction of anti-involution policies, market sentiment warmed up, and the stainless steel market rose rapidly, which drove active spot trading and the recovery in steel mills' profits. And also, the pressure on the industrial chain eased, and the quotation of nickel pig iron rose to 950 yuan. However, as the price continued to rise and the stainless steel market weakened, market transactions gradually cooled. Inquiries from major steel mills entering the market provided a floor for the price of nickel pig iron and supported its upward trend. On the cost side, improved weather conditions in Indonesia enhanced nickel mining efficiency and alleviated some supply tightness. And on the demand side, driven by the expected peak season in September and October, the production of stainless steel slightly increased, and steel mills adjusted their purchasing price expectations upward. And by September, as the performance of stainless steel sector fell short of expectations, inquiries in the nickel pig iron market turned sluggish, and the gap between the price expectations of buyers and sellers further widened. Amid production losses, steel mills showed little purchasing interest, and the nickel pig iron prices began to decline. Some traders lacked confidence in the market outlook and chose to sell at a lower price. So, looking ahead to the fourth quarter, nickel pig iron prices are expected to remain weak, though the cost factors will continue to provide some support. And let's take a look at its costs and profits. In the third quarter, the price of nickel ore in Indonesia dropped somewhat, and the cost of nickel pig iron slightly declined. By the end of the quarter, the CF price of 1.6% nickel remained at $50.5 per wet ton, and the profit margin of nickel pig iron in Indonesia slightly recovered. And next, let's take a look at the refined nickel. In the spot market, the prices first rose and then fell at the beginning of the third quarter, with an overall weak trend. Fundamentally, the market continued to face a supply surplus in China, and coupled with steadily accumulating inventories both domestically and overseas. By the end of the quarter, global nickel inventories had increased to 270,564 tons, and LME nickel inventories rose to 230,124 tons, an increase of 9.8%. This included nickel plate, nickel briquettes, and items like nickel pellets and crowns. But the overall nickel demand was subdued, and all of this put certain pressure on nickel prices. And for its production, China's refined nickel production in the third quarter reached 109,600 tons, rising 2.5% quarter on quarter. So the growth is gradually slowing down. While the demand for ternary batteries saw a noticeable increase in September, some refined nickel producers focused on the new energy battery sector reduced electrolytic nickel production due to factors such as tight raw materials for intermediate products. But on the other electrolytic nickel producers slightly raised their production considering their costs. And meanwhile, Chinese invested electrodeposited nickel projects in Indonesia produced 23,950 tons for the quarter. And some of the production capacity will still be put into operation in the future. And in the fourth quarter, I still think that China's refined nickel production is expected to increase slightly, and the market players are advised to monitor the commissioning of new production lines. And next, let's move on to nickel sulfate. While other nickel products were subdued in the third quarter, nickel sulfate stood out with a strong performance. Overall, the nickel sulfate market maintained an upward trend from July to September. In July, the increase in the production of downstream ternary precursor materials drove up demand, and at the same time, supported by a high discount coefficient for MHP, some nickel salt plants reduced production due to continuous losses, which gradually pushed up the price of nickel sulfate. And entering August, nickel sulfate prices climbed further. By month's end, the price of battery-grade nickel sulfate crystals reached to 27,600 yuan per ton, up 600 yuan per ton from July. This rise was mainly driven by the combination of strong demand, a temporary supply contraction, and firm cost support. And in September, as prices for MHP and high-grade nickel matte continued to rise, and MHP supply was also tight, the overall market showed a situation that the supply does not meet demand, and even imports by some plants were difficult to bridge this kind of domestic shortfall. And looking ahead to October, demand for nickel sulfate is expected to remain firm, with prices projected to have a potential upside around 500 yuan per ton. And about the production of nickel sulfate in China. In July, while the production of ternary precursors slightly declined, the overall production of nickel sulfate still showed an upward trend, driven by increased demand for nickel plate. The tight supply of MHP kept the coefficient at a high level, and the profit margin of nickel sulfate production was meager. In addition, the output at some spot market enterprises was affected by technical upgrades in August, which pushed the spot market prices slightly higher. And entering August, ternary precursor production increased significantly, driving up the demand for nickel sulfate. Coupled with the combined release of nickel plate capacity, integrated producers saw a noticeable rise in their nickel sulfate production. But the profits of enterprises that brought raw materials from outside were under pressure. And with technological upgrades of some enterprises, the supply of bulk nickel sulfate in the market became tight. And by September, although nickel salt plants that had undergone previous maintenance gradually resumed production, the overall operation was still not at full capacity and made it difficult to fully compensate for the supply gap in the Chinese market. And okay, about this nickel market in the third quarter of this year. Next part is about China's cobalt market. Thank you.
Thanks so much, Cora. And the next part, let's move on to cobalt. And let me share my screen first. Okay, so before we get down to the cobalt market in the third quarter, let's first look at the full cobalt supply demand dynamics in 2024, which will help us better understand the market dynamics, the market and appetites. In 2024, the overall cobalt supply amounted to around 290,000 tons in cobalt content, with 220,000 tons coming from cobalt intermediates, 40,000 tons from MHP, and around 30,000 tons from recycled materials. That is, around 3/4 of cobalt supply came from intermediates. On the demand end, the lithium-ion battery sector collectively consumed around 160,000 tons of cobalt metal, and other traditional sectors like alloy and magnets consumed around 50,000 tons cobalt. In other words, the cobalt market was in oversupply in 2024, with an annual supply surplus of around 50,000 tons in cobalt metal, and cobalt prices hovered low throughout the entire year. This slide shows the prices of cobalt and cobalt products since 2024. The prices were persistently on the downward trend until late February this year, when the Democratic Republic of Congo first announced to suspend the export of cobalt for 4 months on February the 22nd. The export control was then extended twice on June the 21st and September the 21st, respectively, which were both marked by an immediate price hike. And the export control was finally replaced by an export quota system, which took effect on October the 16th, making it clear that the market will see continued supply void ahead in 2026 and 2027. But an interesting phenomenon is that the electrolytic cobalt prices showed more significant volatility compared with other cobalt products, partly due to its high inventory and stagnant downstream demand. And the prices even pulled back a little bit in the past few days, and the causes are complicated. Firstly, the supply gap created by the producers' production cuts has been insignificant when the overall electrolytic cobalt stocks are around 18,000 tons. Secondly, some electrolytic cobalt entered the Chinese market when the arbitrage window opens. Thirdly, domestic demand remains stable with limited growth, as downstream consumption is flat at present and is expected to weaken further in the fourth quarter. That is, quick destocking is unlikely seen from the demand end. Fourthly, the players have not started to dissolve electrolytic cobalts for the production of other cobalt products, though it remains the fastest method for inventory digestion in the future. Fifthly, the financial attributes of the cobalt market have led to profit taking of some long positions, which suppressed price increases and triggers a sell off. However, from a medium to long term perspective, the tight supply of cobalt raw materials will persist, and the electrolytic prices are still expected to rise. On this slide, I have compared the year-to-date production of major cobalt products from 2020 to 2025. First, the lithium cobalt oxide production amounted to around 86,000 tons in the first 9 months of 2025, rising 30% compared with the same period last year. LCO battery is mostly used in electronics and some innovative products like wearables and drones, which generated more demand for LCO batteries. On the other hand, the top-tier battery cell factories have been actively building stocks in anticipation for persistent cobalt price hike, and this activity has also encouraged the cathode factories to ramp up the production. Therefore, in October 2025, China's LCO production is projected to reach 11,600 tons, representing a month-on-month increase of around 2% and a year-on-year increase of 20%. October remains the peak season for the traditional golden September and silver October, and downstream battery cell factories are expected to place orders for the mid to late fourth quarter and early first quarter of 2026. Therefore, with sustained demand support, the LCO production is anticipated to rise further in October. And China's ternary cathode material production also experienced steady annual growth in 2025. Though its market share has been low, still squeezed by strong LFP demand, the growth is enabled by the resilience of the entire electric vehicle market, especially the successful launch of some models like Xiaomi vehicles. So in the first 3 months, in the first 3 quarters of 2025, China's ternary cathode material production was around 540,000 tons, rising about 14% year on year, according to my stills data. While the ternary cathode material production in September was largely supported by CATL supply chain, the production in October is estimated to decrease around 4% month on month at around 78,000 tons, but it is still up 36.7% from last year. Despite a monthly reduction, the production in October is still at a high level in recent years. And on the contrary, China's electrolytic cobalt production stood at around 26,000 tons in the first 9 months of 2025, which was down 10% compared with the same period last year. To be more specific, the monthly electrolytic cobalt production has been gradually falling since this March, and the monthly production was merely around 800 tons in September, against more than 4,000 tons in the same period last year. In September, domestic supply of cobalt intermediates tightened further, with prices continuing to rise. Meanwhile, the profits of electrolytic cobalt was constrained by high inventory levels and weak demand, with the profits in the negative zone. As a result, the producers stick to the production reduction strategies, with approximately 60% of producers halting the production. And the integrated producers prioritized the production of other cobalt products due to limited raw material supply. MyStew anticipates that China's electrolytic cobalt will keep contracting to around 600 tons in October, although a supply-demand gap for electrolytic cobalt has emerged since September. Domestic inventory levels remain high and are difficult to digest in the short term, as is explained earlier. And it is unlikely that the profitability of electrolytic cobalt will return to the positive very soon. In this case, the electrolytic cobalt producers are likely to keep reducing the production in October and onwards. This slide shows the theoretical immediate profits of major cobalt products based on the raw material and finished products prices. The profits of electrolytic cobalt were in the negative. This also indicated that though almost all cobalt products prices experienced significant price hikes following Congo's cobalt export control, the players faced a totally different landscape due to different demand dynamics and inventory levels. And here comes the important part, our outlook into the rest of 2025 and a glimpse of 2026. In fact, the drastic volatility in the cobalt market is almost fully driven by Congo's export control, and the latest export quota system has heralded endured supply shortage in the next few years. According to the quota system, the remainder of 2025 is set with an export quota of 18,125 tons. And for 2026 and 2027, the export quota has been set at 96,600 tons each. Among them, 87,000 tons are basic quotas and 96 tons are strategic quotas reserved for projects with national importance. Therefore, we expect that the cobalt supply from Congo will likely be more than halved in 2025, primarily due to its export control starting the beginning of this year, which is estimated at around 68,500 tons in cobalt content. On the other hand, the cobalt supply in the form of MHP in Indonesia will slightly fill up this supply void with the commissioning and ramp-up of new projects. While the demand end is expected to increase marginally compared with 2024, the year of 2025 is expected to see a supply shortage of around 45 45,000 tons in cobalt content. And the cobalt intermediate prices will likely see an annual average of around $15 per pound CIF China, which is a significant rally from an average of around $11 per pound in 2024. And attention shall be paid to the electrolytic cobalt inventory, which will likely fall rapidly when the players start to dissolve it and to produce other cobalt products. In 2026, let's assume that the cobalt supply from Congo will stand at 96,600 tons in cobalt content as is suggested by the quota system. The cobalt supply in Indonesia is projected to maintain an annual growth of around 30%, and high cobalt prices will encourage the mines outside Congo to accelerate the production, though the increase is expected to be very small. Besides, the cobalt supply in the recycling sector is expected to largely remain stable with marginal increase. Together, the global cobalt market is anticipated to see a supply shortage of less than 10,000 tons in cobalt content in 2026. But if we count in the stock build-up needs of players and the sellers refraining from selling, the actual supply shortage will likely be much greater than just 10,000 tons. And in 2027, in Indonesia, the recycling sectors and mines outside Congo will keep bringing additional supply, which will slightly narrow the supply gap to less than 5,000 tons in cobalt content. However, there is still concerns like the stock build-up needs of players and sellers refraining from selling. As for cobalt intermediates, the prices have moved all the way up from around $6 per pound at the beginning of the year to $22.5 at present, and might still expect that the prices could close the year of 2025 in the range of $25 to $28 dollars per pound CIF China and target $30 in 2026 with ongoing supply shortage. And this is the end of our webinar today. And if you have any questions or you are interested in the deck we showed today, or you are interested in my steel data mentioned earlier, please send us an email at inquiries@mysteel.com. We will reply accordingly. And thanks again for your time and for your constant attention. Until next time, bye-bye.